Hi, my name is Brian. Welcome to this journey through space. Today we are going to study the chapter, which is Introduction to Insurance. In this chapter, we'll explore what insurance is, why it exists, how it has evolved, and its role in modern economies. We'll also look at the different types of insurance, key principles, global and Indian markets, and regulatory bodies that keep the system fair and efficient. Course overview. This course, Fundamentals of Insurance and Risk Management, gives you a complete foundation in how insurance works. We'll start with theoretical concepts, then examine real-world applications. By the end, you should be able to analyze different insurance products, evaluate their role in economic stability, and apply risk management in practical situations. Assessment will include written assignments, group presentations, and a final exam. The skills you gain here are not only academic, they are directly relevant to business and policymaking. What is insurance? Insurance is a contractual arrangement where an insurer promises to compensate for specific losses in exchange for a premium. It's essentially a risk transfer mechanism, shifting financial risk from individuals or businesses to an insurer. This allows people to plan their finances without living in constant fear of catastrophic loss. By pooling resources from many, insurers can cover the losses of the few. In this sense, insurance acts as both a safety net and a stabilizer in uncertain times. Purpose of insurance. The main purpose is risk protection, shielding against unpredictable financial shocks. It also offers financial security, ensuring stability in long-term planning. Through risk pooling, losses are spread across many policyholders, making them affordable. Importantly, insurance supports economic growth by enabling entrepreneurs to take risks, knowing they have coverage for potential setbacks. Without insurance, many modern business ventures wouldn't even be possible. Historical development of insurance has ancient roots. Babylonian merchants around 1750 BCE used early risk-sharing for trade caravans. In medieval Europe, guilds offered members protection funds. The 17th century saw the birth of modern marine insurance at Lloyd's Coffee House in London. The 18th to 19th centuries brought the first fire and life insurers, along with actuarial science. In the 20th to 21st centuries, we've expanded into health, auto, and even cyber insurance. Key milestones in insurance evolution. In 1693, Edmund Halley created the first mortality table, founding actuarial science. In 1945, comprehensive insurance regulation emerged post-WWPRID, standardizing industry practices. The 2000s brought the InsurTech revolution, using AI, big data, and mobile platforms to transform customer experience. Each milestone reflects how insurance adapts to societal needs and technological change. This adaptability is why the industry continues to grow globally. Economic importance of insurance. Insurance contributes 5 to 7% of GDP in developed nations, employing millions and managing trillions in assets. It acts as a financial shock absorber during crises, preventing economic collapse. Businesses rely on insurance for loans, trade, and innovation support. Insurance penetration, premiums as a percent of GDP, is a key economic health indicator. Countries like the US and UK have 10 to 12% penetration, while developing economies often fall below 5%. Insurance as an economic stabilizer. Insurance prevents cascading failures after disasters by providing quick payouts and funding recovery. This stability boosts investor confidence. It also allows governments to focus resources elsewhere during crises, knowing insurers will absorb part of the financial burden. In this way, insurance strengthens not just individual businesses, but entire economies. It's a silent but critical part of the economic infrastructure. Fundamental principles of insurance. Key principles include utmost good faith, honest disclosure of material facts, insurable interest, you must have a stake in the insured item, and indemnity, restoring the insured to pre-loss condition. Contribution means multiple insurers share costs proportionally. Without these principles, insurance would be prone to abuse, leading to higher costs and reduced trust. More insurance principles. Additional principles include subrogation, insurers' right to recover costs from the at-fault party, proximate cause, the main cause of loss must be covered, and loss minimization, insured must take steps to reduce damage. These rules protect both insurers and policyholders. They ensure fairness and discourage negligence. A strong grasp of these principles is vital for anyone entering the insurance sector. Types of insurance providers. Providers range from private insurers, stock or mutual companies, to public insurers, government-run, and specialized entities like reinsurers. The distribution method, brokers, direct writers, or independent agents, affects customer experience and pricing. Brokers offer wide product choice, while direct writers streamline communication. Each model has its strengths depending on the product and market. Wadadlai. Key insurance terminology. Basic terms include premium, payment to the insurer, policy, contract, claim, request for payment, and deductible, amount paid by insured before coverage. Technical terms include underwriting, actuary, reinsurance, and loss ratio. Knowing this vocabulary is essential for understanding policy documents. It also helps in communicating effectively with industry professionals. More essential terms. Terms like sum insured, exclusions, endorsements, perils, and riders define coverage scope. The grace period allows extra time to pay before a policy lapses. These details matter. Many disputes arise from misunderstanding them. Being clear on definitions can save significant time, money, and frustration. Global insurance market. The global market collects around $5 trillion in premiums annually. Developed economies dominate, but emerging markets are growing faster. North America and Europe have mature tech-driven markets. Asia-Pacific, Latin America, and Africa are catching up, driven by rising incomes and digital adoption. This growth offers vast career and investment opportunities. Indian insurance market. India's market totals are $9.2 trillion in premiums, with 3.2% penetration, well below the global average. It has 57 insurers, growing at 11.4% annually. The gap between population size and insurance coverage signals huge growth potential. Rising awareness, a growing middle class, and technology adoption are accelerating the shift. Global versus Indian market. Global markets feature high penetration, diverse products, and advanced regulation. India is still developing, with traditional products dominating but innovation on the rise. Regulatory frameworks are evolving to match international standards. The protection gap remains large, representing both a challenge and an opportunity. By 2030, the market is projected to reach $237 billion. Insurance regulatory bodies. In India, the IRDAI regulates the industry, protecting policyholders and ensuring solvency. Globally, bodies like IAIS, FCA, UK, NAIC, USA, and IOPA EU set standards and promote stability. Regulators balance consumer protection with industry growth. Strong oversight builds trust, which is the foundation of any insurance market.